Because by law, the Fed has twin goals: full employment and stable prices. That boils down to asking the Fed to fine-tune the economy. That's a tough job, and many economists think it's impossible. These economists argue that fine-tuning interest rates away from market levels is just price fixing. Interest rates are the price of money, right? History shows that price fixing doesn't work very well for other goods and services, and they think it doesn't work with money either. These economists would rather see the Fed just set a rule and follow it. Under a system of monetary rules, the Fed would let the money supply grow a few percent a year and let interest rates settle where they may. You might be saying, as an investor, do I need to care what the Fed does? Yes and no. Yes, Fed actions absolutely do affect the economy and the stock market. Walker Todd is a PhD, JD, and research fellow at the American Institute for Economic Research, who spent 20 years as a legal officer and later as a research officer at the Federal Reserve Banks of New York and Cleveland. Dr. Todd explains that the Fed's open market operations can have a measurable effect on stock market prices. Monetary tightening operations, which usually raise market interest rates, tend to reduce domestic activity and cause share prices to fall. Monetary easing operations, which usually lower interest rates, tend to increase domestic activity and cause share prices to rise. But no, you can't expect to make money by trading on Fed actions unless you can outguess the experts. The markets are really efficient with respect to Fed activity. Fed actions are supposed to be transparent and predictable anyway, so when the Fed acts, it shouldn't be a surprise that would affect market rates. It doesn't work that way in practice, of course. Former Federal Reserve Chairman Alan Greenspan reportedly once said, tongue-in-cheek, "If you understood what I said, I must have misspoke." Fed spokesmen are indeed more open than they were in decades past, though. The Federal Reserve is a great source of information about the economy and the stock market. All of the regional banks have good websites with lots of information, and most of them have at least one publication that you'll find helpful. If you're searching Federal Reserve Bank websites, look for links that say something like education or publications or research. You'll find all kinds of articles and videos. Some of the material will be too basic for you, and some, particularly the sophisticated research articles, will be too specialized and esoteric to be helpful. But you'll find plenty that you can use. I'm personally fond of the Cleveland Fed's Economic Commentary series. For example, you'll find articles like "Why Are Interest Rates So Low?" by Joseph Haubrich, written in 2013. You're busy, you want the main idea rather than a lot of detail, and you'd rather see a graph than an equation, right? Dr. Haubrich's article is just 4 pages, including figures, and he wrote it with people like you in mind. At the Atlanta Fed, you'll find economic and financial highlights, such as historical information on international trade or light vehicle sales. The Fed's research economists blog about topics ranging from banking to real estate to inflation. Give their site a look. Those are my favorite sites for articles, and the Fed system also offers data galore. Some of the data from this lesson are from FRED, for Federal Reserve Economic Data, produced by the St. Louis Fed. The last time I checked, FRED contained almost 150,000 economic data series. Exchange rates, inflation rates, stock prices, housing starts. Just about any data you want is there, and it's free. The stock market is also affected by what happens to foreign currencies. Not every country uses US dollars, of course, and changes in the value of those currencies in relation to the US dollar can influence the economy. For example, the countries belonging to the European Union use the euro as their national currency. The number of countries using the euro has varied over time. Now the figure is around 20, including major economies such as Germany, France, and Italy, plus a host of smaller economies